All right, I want to welcome everyone today to today's topic, advanced retirement plans, particularly for small business owners. We'll note that we have the mics on mute today. So please use the Zoom Q&A feature, okay, kind of at the bottom there, to submit questions at any time, and we should have plenty of time in the session for questions towards the end for Sierra Pacific, as well as our guest presenter, Adam Zuro. With that, let me cover quickly the agenda. Advanced retirement plans for small owners. We'll do some quick introductions about Sierra Pacific. We'll let Adam talk a little bit about Nicholas Pension Consultants, his backgrounds, and the like. And we will then just jump right in. Okay. And as mentioned, towards the end, we will have a short summary where we can allow for some questions and answers on the topic. With that bit of housekeeping taken care of, Adam, you're still with us. Yes?
I am after the beautiful music.
Excellent, excellent. All right. We've worked with Adam here from Sierra Pacific for a while. Their organization covers clients across the nation. He focuses here in the Bay Area. With that, Adam, you have the floor.
Perfect. Well, thank you and welcome everybody. I always start out and I ask my whole family. I come from a large family. I say, "What do you think I do for a living?" And they all think I sell life insurance. So
Isn't that the same? Isn't that the same thing? Life
like,
insurance,
they all think
advanced retirement plan.
right. So I need the Kirks and the CPAs of the world to refer me in because nobody knows what I do. I'm a specialist and I'm a third party administrator. That means when you have a 401k, a profit sharing, a defined benefit, what they call qualified plans, a tax return has to be filed on it. That's what my firm does. My firm files that tax return. So I'm a glorified CPA, basically. But what I do is I understand retirement plans, not only the qualified plans, the 401ks, profit sharings, defined benefits, but also the off the shelf, the SEPs, the simples, the mandatory state run plans. I understand them enough to help guide businesses into the right area. And when you think of a retirement plan, everyone thinks, oh, it's a benefit for my employees. I need to get a retirement plan so I can have a benefit just like I have health insurance.
Right.
I think of it a little differently. I think first and foremost, these retirement plans can be a tax savings vehicle. So a tax you can save on taxes. That's first. How do I save as much taxes as possible? In a typical 401k profit sharing plan, someone over 50 years of age could shelter up to $76,000. $76,000 that avoids paying state and federal taxes this year. That's huge. And you can even go more than that. So the tax savings is first and foremost on my mind always. Second on my mind is a savings account. While we're making money, while we're in our biggest earning income years, the government's taking half of it. So if we can save it instead of putting it with the government, that's going to be a forced tax savings as well as a tax credit and a savings vehicle. And then lastly, it becomes a benefit for the employees because we can't get out of Dodge without doing something for the employees. We're going to take care of the employees and we will take care of the employees. So that's what I'm always geared at. And so that's where I start out. So I help clients and I just consult on what's the best move for your particular business, depending on your employees, who's the owners, how much money you're making, how much you want to put away. It all depends on where I would steer you. But as if you would flip to that first page, the landscape has changed in my world. And in my world, I used to go to some clients and some companies and say, you know what? You don't need a plan. Skip it. You're writing enough off. You're buying the right equipment. You don't have a tax burden. You're still getting by. Everything's working right. You don't a retirement plan's not necessary for you. But the landscape has changed. California is one of, I think, 13 or 15 states that require that if you do not have a retirement plan, a 401k, a SEP, a simple, defined benefit, a profit sharing plan, if you don't have some sort of retirement plan, then you have to sign up for California CalSavers plan. This plan, as you see, has been going on since 2020. My firm got a letter from the state of California in 2020 and said, show us your retirement plan or sign up for this CalSavers plan. That started in 2020 for any company that had over 100 employees. In 2021, they lowered that limit down to you only have to have this state run plan if you have over 50 employees. Currently, we're sitting at if you have 5 employees or more, you either have to have a retirement plan or you have to sign up for this CalSavers plan. Well, what's changing? End of next year, if you have one employee, even if that employee is your spouse and doesn't own any part of the business, then you are going to be required to do something. So any company with one employee is going to have to make a decision. What do I do? Do I sign up for this CalSavers or do I look into a SEP simple 401k profit sharing? And CalSavers is nothing more than a Roth IRA. It's a Roth IRA, and the IRA limits apply. I think it's what is it, Kirk? It's 8,000 for those over 50. You could put in 7,500. So it's a deferral into a Roth IRA. It's a mandatory automatic deferral for all your employees into a Roth IRA. If you're an owner and you make under a certain income limit, you may also participate in that Roth IRA. But if you make over a certain income limit, they won't let you put your money into a Roth IRA. So basically, the CalSavers is just saying, at least let's make the employees put something away. We're going to mandatorily make them put money in there. So that's what's changing in my world is you have to make a decision. Now, if you have over 5 employees, you got to make that decision now because I have in the last few years, I've been getting more interested in this CalSavers plan because I didn't think it would have enough teeth to keep going and they can enforce it. But if you look down there at the bottom, if you fail to register and fail to put your company in this plan, they're going to fine you $750 for every non-highly compensated employee. So right there, $750 they're going to fine you. First 250 and then after 180 days another $500. So they're going to fine you. And I really didn't think they were going to do that. I really thought this was going to come and go and it was going to be like something that was on the books. I always equated it to if someone spits on the sidewalk in Palo Alto, it's a $750 fine. But no one ever got fined. So I thought it was going to be one of those laws. But they have enough things going on now that they're enforcing it. And I have seen clients come in because when they file their tax return or when they file their monthly reports, their monthly payroll, the California catches it off that DE 9C section. So they're catching it and they're getting fined. In my other webinars, I usually put up a screen that shows a buddy of mine that got a $9,500 fine from the California state saying, where's your plan? And we quickly
Wow.
set them up in a 401k plan. So this is reality. So then the next section is if you turn next, what do I do? Then what do I do? What type of plan should I work with? So I always look at the basics. This is a basic defined contribution. And as I mentioned in the far right-hand corner, the individual limit for one person over 50 years of age is 76,500. So I'm always looking at a plan to say, how do I put this business owner in and get them 76,000 in there? And what's the minimum I have to pay through the employees? And there's all these different ways, and I'm not going to get into the weeds with it, but there's different ways to put money into plans. You know, there's salary deferral coming from the participant, which the owner is the participant. The company matches those salary deferrals, and then there's a profit sharing that has nothing to do with profits. It's just they're saying I'm going to give everyone a percentage of pay. And my goal is always to try to figure out for you business owners, how do I get the maximum dollars in there? And then what's that cost to the employees? So I'm constantly trying to figure that out and worry about getting by these discrimination tests. And that's always my goal. Now, sometimes if you flip to the next page, Sometimes if it's just a husband and wife, I would say do a SEP because you can do the profit sharing or that 25% of pay, that might be enough. So if it's a husband and wife, I say do a SEP, or if it's just business owners only, do a SEP. If it's just business owners and family members, do a SEP. A SEP does not involve me, and you just decide to put in anywhere from 0 to 25% of everyone's pay, you're done. You can still get to the maximum limit of 69,000, assuming you make enough money, but it might work. But if you have employees, oh boy, now it's going to get expensive. So then I would switch to, if I had employees, I'd either look at a simple IRA that doesn't involve me. It doesn't allow you to put that much money in, but it still allows you to defer some money in and match a little bit. You're not going to get to that $69,000 limit, but it's not a bad start for smaller businesses, and they're required to match the employees. This is a good opportunity. They only have to match employees that contribute. So a restaurant, a construction company, it's so hard to get them to contribute. If you only match them if they contribute, it may cost you nothing in that simple plan. So sometimes a simple makes sense. So I'll steer people to simples. If they want more money in there, then that's where I went back, go back to the slide before that, if you would. If they want more money than that, reversing back to that defined contribution plan, I would say now we do a 401k match, far left-hand corner. It's called a safe harbor match. Now I could be getting in a husband and wife over 50, $30,000 each, 60 grand plus matching. I might be able to get 75,000 in a small plan for a little small construction company. And if the employees don't contribute, it costs nothing to the employees. So there's all these different ways to make this a tax vehicle. If we're really humming along, and I'm going to have you skip 2 pages, or skip one, I'll go to the 2 pages to the defined benefit plan. If we're really humming along, and let's say you're a doctor, dentist, or a lawyer, and you have money that, and you're really getting in the higher tax bracket, and let's say you're getting in my age group, age 50, 58. Now, if you look at my DB chart, a defined benefit, now I might be able to put away instead of 76,000, 310 grand. So now I could put 310 grand for a business owner and still give a nominal amount. That cost will vary depending on the ages of the employees, but it could be an absolutely huge tax savings. I refer to it as a cash balance, but the word out on the street is, I refer to it as a defined benefit, but the word out on the street is cash balance. Everyone refers to it as a cash balance. There's a lot of stickiness to it. It's mandatory 3 to 5 years. It's expensive to run. It's kind of fluid, but boy, the right people. I usually get thrown under the bus on every occasion. So something goes wrong. I'm always the person that goes wrong, because there's so many things that go off in plans. But I can't tell you how many times after I complete defined benefit plans and fully fund them that people have sent me bottles of wine and they're just elated. They said I would have never have saved that kind of money without even feeling it. So defined benefits are a great catch up and they're referred to as cash balance plans. The good part about all these plans, whether it's a 401k, a profit sharing, a combination defined benefit cash balance, is they're coming in and giving everything away. That would be the next slide. They're saying that if it typically costs $1,000 to set it up and $2,000 a year to administer, your first year's fees are 3,000. The 3,000 that you pay is a tax deduction. Now they're coming in and they're saying, not only do you get a tax deduction for new plans, because they're trying to encourage new plans, not only do you get that $3,000 tax deduction, but they're saying that you can also take a tax credit of up to $3,000. So they're trying to really, really come in and say, let's make these plans, let's get them out there. Please put them in where we want savings, because they're thinking, if I can let the business owner put a boatload of money away, at least the employees are being taken care of. So that's their goal. So they're trying, so the fees should not be an issue for the first few years. Absolutely not in thinking about these retirement plans. Um, Now, in each different case, whether you're a construction company, whether you're a CPA firm, an architect firm, whether you have many employees or only 1099 employees, it all differs and it changes. So what do I need? I always look for the next screen. I'm always looking for, and I always say, who's who in the zoo? Who is it? What company do you own? What type of entity is it? What's your goal? And then the next one is who's there? Who are the employees? Who are the owners? When were they hired? More importantly, what's their date of birth? Because the government lets me discriminate for older employees because they're going to retire sooner. So if I typically, which typically happens in businesses, is you have older owners and younger employees. I can use that to my benefit. So I always want to say, I always call Kirk, and if Kirk shows me a census, I can quickly say, okay, SEP all the way. If they're happy putting in 69,000, SEP all the way. If they're have employees, if they're willing, if they want to get in 20, 30,000 between the husband and wife, maybe do a simple. Oh boy, I see it's an S corp. They're showing 150 of income, but they got K1 distributions of 300,000. Let's look to a profit sharing or a defined benefit plan. So I can help guide you guys into what's the right retirement plan because as I said from the beginning, you got to make a decision that or you're going to start getting fined from the state of California and be required to join in their CalSavers plan. And as a minimal, do nothing. I don't care. I don't need to worry about taxes or saving anything. Do CalSavers. Go along. It's not going to hurt you. It's easy. It's non-invasive. It doesn't cost you anything. It's just the upkeep. It's the upkeep of doing it. If you're going to go through all that effort, might as well give Kirk a census and see what we can do for you on a tax deduction, tax savings basis.
Yeah, and I want to point out, as intimated here by Adam, that they've been kind enough at Nicholas Pension to have these as handouts. It's actually in an Excel format. Should you need to fill one out and take a look at whether some of these advanced plans work for your business. So you go to their website, and all of these shown in the presentation are available for handout, which is great. Want to thank you for that, Adam.
Yeah. And on that same front, Kirk, I would say, let's say they already have a plan. You already have a plan in place.
Right.
Call Kirk and let's review it because there's some little twist we can do that would make this a tax vehicle for you and you just weren't aware of it. My first meeting I ever went to in my career was 24 years ago, and I sat across a gentleman from Paychecks and they were cheaper, they were better, they were all informed, and I was so mad. I went down to my business partners and I said, "Well, they're going to kill us.
Yeah.
Paycheck is phenomenal." I've taken over so many plans from Paychecks just because they haven't always known what to do and the right things for them, and they get them in trouble. And I'm not knocking Paychecks or payroll, but there's a specialty to these things. And I've been able to come in and take someone that's just had a normal retirement plan and made it a huge tax vehicle by saying, let's see if we can legitimately put your spouse on payroll. Let's see if we can change the allocation to benefit the older owners and do different things, add on a cash balance. So taking a look at it will be good, even if it's just a fine tune, a couple tweaks here and there. We don't have to do anything. You can take it back to your TPA and your current advisor and work with them. But you want to get a checkup on it. We don't mind doing it. It takes us, not too long to review it, and we're more than happy to do that.
Very good. And we'll note as well that at Sierra Pacific, we really strive to be our clients really like their CFO for their own personal as well as their business for their small business owners. And what we have found is that for many, they are somewhat unaware of some of the more advanced opportunities that you're kind of going over, and for a lot of times, even we like to work very closely with our client CPAs. Sometimes some of the CPAs are less familiar with some of the more advanced ways here for an organization to provide, not only better benefits, but opportunities for greater retirement savings for them and often their employees, top employees,
Right.
and their spouses.
And I think I always say the CPAs are the key to the kingdom. We all have faith and trust in our CPA, and I get it. But I'm shocked on, like you said, these laws changed so much. In my world, just in the last 2 years, 95 new laws came up. Secure Act is driving everybody nuts. The
Right.
CPAs can't keep up with it. So I always, anytime we run numbers, Kirk and I run numbers together, we always come in and we say, run this by your CPA because it's first a tax move. So we want the blessing of the CPA, and I wouldn't make a move without saying, okay, I'm thinking about setting up this cash balance or this 401k. Make sure because there might be other ways to avoid it where you wouldn't have to pay any of the fees to set these plans up. So I always go back to the CPA.
Very good. Okay. The next one was your fees.
Yeah. So there's fees for involved in these plans. As I mentioned, all fees are tax deductible, but if it's a new plan with employees, oh boy, you get a tax credit coming back on top of it. So the fees are really not an issue to begin with. But our fees tend to be on the lower end of the Bay Area. We are located. My main office is located in Rancho Cordova, so we can own the office building. We can staff it a tad cheaper. So we tend to be about 20 to 30% less than most Bay Area companies in the fee in the administration fee. A typical plan, like I mentioned, a 10-person plan would probably be about $1,600 to set up, one-time setup, and then another $2,200 a year to administer. So that would be our fee to complete the what we call a tax return of 5,500. That's what we give to the IRS and says this plan is in compliance. And then we're getting all the tax advantages and savings and keeping the plan in compliance. One of the things that you've got to be aware of is this is sticky. The government, for some reason, likes to pin their ears back and go and fine you. If you miss one day of filing a 5,500, boom, they start hitting you for $2,200 a day. And they impose those fines, so it could get very expensive. My first goal, is to keep everyone out of trouble. Keep you out of trouble. Put as much money in there as you possibly can. See what the minimal cost would be to the employees. You can always increase it. That's what we always aim to do in there. But so there's my fees. Obviously, the 401k on the top, the defined benefits if you do them alone. Most defined benefits are a combination of defined benefit, defined contribution plans. And if you notice, it's hard to get fees out of anyone. They're almost like lawyers. They nickel, so we try to keep it clean. We're not trying to make a million on anyone, but so our fees are pretty clean.
Is there any trend that you're finding in the industry insofar as providers such as Nicholas Pension, insofar as their fee structures and the like, Adam?
We're seeing a bunch of online companies coming in AI, and they're trying to do this, and it almost scared me, just like Paychex scared me when they got into the business 25 years ago. Like, oh boy, they're going to be really good. On the onset, they're growing quickly, but what I've seen is these AI computer generated run businesses. They're not thinking. I mean, I had someone set up a plan, no lie, for 2023. The effective date was December 18th and to the end of the year. And that's what they made it. And that was the only income they could look at. It was like, is anyone thinking about this? So that I see that trend. The biggest trend that I see that's gonna everyone well, in my world, but most people in the retirement world are going to understand it is next year they're forcing anyone that has a 401k plan in place since 2023 to automatically enroll their employees. So if you have 10 employees or more and you put your plan together last year and moving forward, they're going to now require that you automatically enroll those employees. They don't have a say so. They can opt out if
Opt
they,
out.
but you opt them in. That's going to bring up a lot of things. That's going to be interesting. How everyone handles that is going to be what I think is going to be the biggest talk in the next 12 to 18 months. It's supposed to be implemented and started on the first of 2025. And I keep arguing with my partners, and I'm saying they're going to push it out. But I'm
Right.
down to days now whether or not it happens. It looks like it's going. Yeah.
That's right. Less than a month left of the year.
Yeah. And that going quick. Yeah.
Right. The remaining information we can provide from our perspective at Sierra Pacific, how we work with third-party administrators. So Sierra Pacific, we are an independent RIA, and so we work with all the other parties to provide really a holistic approach for the retirement plans for our business owner clients. Now, the services provided to parties are just summarized here briefly from investment management towards the left, providing ongoing advisory services surrounding those investments in the center with the third party administrators. They do the bookkeeping, the fees, as we've kind of summarized here before from Adam, as well as the administration. And of course, to meet the IRS guidelines. And then there's the custodians of that actually do the account maintenance transaction. For retirement plans, we work very closely with organizations like Adam here to offer opportunities for small business owners that really get the most out of their retirement plan that they offer for their employees. And much of the time, it's to the best benefit of the business owners themselves and sometimes their family for the opportunities they have to really increase the amount of tax deferred savings they can get with some of these more advanced plans. Okay. Um, Quick summary of our retirement plan services. We can plan and design help those comparisons necessary. Certainly, portfolio management, including different models that we can take a look at to see what might best work for that organization and what, depending upon what the owner's plans along. And also want to remind everyone that Sierra Pacific, we are a fiduciary, right? So we do best just for our clients. And certainly, we help manage the performance of uh, the uh, the financial aspects of the plan itself. All right. With that, we are at our Q&A section. Um, we'll note that there were a couple questions um, that were asked. And I think, Adam, I think you should be able to readily address this one. One had to do with, um, I think you kind of intimated a little bit in some of your experience, what you've seen with someone that, but essentially it was, I think, if I do nothing, can the state of California go after me? That's kind of summarized.
Yeah, they are. I was living with a friend when I was in between houses, and he asked me what he should be doing, and it was his second company. I said they don't have enough teeth because they're worried about counter lawsuits. Part of that, those new 95 laws, they got a plan that walks and talks and acts like the CalSavers, so they have more teeth, so they're coming after you. So if you don't get it, they will come after you. If you have 5 employees or more, they're going to send you a letter. They'll give you a warning. And then if you don't put something in place, you'll either have to sign up with them, which is may not be the worst thing, or you should be looking into some type of retirement plan.
So you've actually seen that from a
Yeah.
personal experience with someone you knew.
Oh, and he sent me the fine, and then I
Oh,
jokingly put it up on the on my last webinar, and he didn't appreciate it. He's all, oh, now you're making fun of me, and I'm like, oh no, I'm not. I'm sorry. Yeah, we did get it. He did not have to pay it because we quickly set up and showed proof of a 401k plan for him.
Very good, very good. And largely, conceivably, that's the main impetus anyway, right? Is to get the plan.
Right.
Very good. The other question we had is where do I start? Where would I start, I guess, how it was worded.
The easiest way is having a conversation with us. But if I get that census, name, date of birth, date of hire, if I can
Right.
understand what's going on with your particular company, then quickly I could see what opportunities you have. And I always say, give me everything. I'm not look whether I put a plan in place and you put $1 million in or you put $10 in.
So
I
you're talking, Adam, you're talking about this plan here,
the
kind of
census
the
form,
spreadsheet.
exactly.
Okay.
Yeah.
All right.
Thank you. Yeah, I'm talking about the census form. So if you get me the information, get Kirk the information on the census form, we could quickly have a nice conversation on what would be some options for you. Yeah, you give you aggressive, a high contribution, lower contribution, the most invasive way. So we'll help you figure out what's right for you.
Very good. Very good. Adam, we had no more questions and definitely want to thank you very much for your participation. It's been a very compelling topic. As I mentioned, we find in conversations, not with just our business owners, but some CPAs that we work with on behalf of our clients as well, that, they are less familiar with some of the more advanced options when they're combined and the like. So this has been very helpful. Want to thank you for
One
your
second, Kirk. I do
yeah.
see two questions come in. Did you see those?
Hold on. Let me check. Yes. As a
Yeah,
matter of
does
fact, we did.
sole
Okay.
proprietor with no employees need to enroll in CalSavers?
That's a
No.
good question. All right.
Good question. But let's say you're a sole proprietor and you pay your spouse. Now that spouse becomes an employee. So no. So right now, as long as your spouse is not on there and you have no employees, you're golden. Your goal, if you're thinking about putting money away, you think of, do I do an IRA? Put 7 grand away. Do I do a step IRA? Put 25% of your pay away. If that's not enough, and let's say you make 100 grand and you want to put and are you showing 100 grand of income, you could put 25 grand away. Or if you did a solo 401k, you could put 25 grand away plus your salary deferral. You can get closer to $45,000. If you wanted more, we look at a defined benefit. So your options, you don't have to do anything unless you're looking to put money away at a tax deferred rate. That makes sense?
Yeah. Okay. And the other question, it's noted that you came in. How much does your business need to make to be eligible for a DB plan?
In my opinion, so it's not how much you make because we all lie about how much we make. We show as little W-2 as possible, and you have the
Right.
K-1 contributions in a corporation. And I don't say we lie. We never show, we're trying to show as little income as possible. In my opinion, if you're thinking about doing a defined benefit plan, you probably, if it's just you, there's no spouse involved, there's no way to legitimately
Okay.
put spouses on payroll. If it's just you and you're in your 50s, we could potentially get you $76,000 in a solo K.
I
So
think
my cutoff point would go ahead.
I think you'd covered that in the
Um,
comparison here.
go back the other one, the DB, go forward one more. Yeah, right there. So I did
Okay.
cover
Yeah.
that there, but
Right.
but the question is how much does your business need to make to be
Make.
eligible for the DB plan? That's the maximum numbers. And
Okay.
you can always put in minimal numbers, but my question is why? If you're an individual and you're over 50 years of age, I would say unless you want to put in more than $100,000, don't do a defined benefit plan. Because you could, if you make enough money, you can get $69,000 in a SEP. If you make enough money and you're over 50, you can get $76,000 in a 401k profit sharing with the catch up. So and so to put in an extra 20, 25,000, the cost involved wouldn't be worth it and the commitment involved. So I would say probably anywhere from 90 to 100 grand would be my thinking point. Now, unfortunately, if you're only 32 years of age, You can't even put in that much money. So a defined benefit is for older individuals with younger or no employees, and they're wanting to put in more than 80, 90,000 to $100,000. That would be my rough litmus test. But I've done less for people just because of different commitments and made it work because I still had 401ks I can add on there. But that would be my general rule. You want to definitely be able to put in more than you could in a defined contribution plan. So the dollar amount your business is earning is kind of irrelevant, but if you don't
Mhm.
have the income to offset it, why do you want to put that money away? Because you're going to get this huge deduction and you won't be able to deduct it against any. Yeah,
Right.
yeah,
That makes sense.
yeah.
All
So
right.
I hope
I
that answers
think,
your question, Jacob. Yeah, but
all right. I don't see any other questions. So with that, I want to thank our presenter, Adam, once again. Always a pleasure and
yeah.
certainly enjoy the content. And even though we work together, learned a lot myself in the presentation doing this. So with that, I want to thank everyone for your time and remind everyone that the handouts here are available on nicholaspension.com, including that spreadsheet, which is the place where you can start with the census. All right, with that, thank you very much and have a great day.